Help us with where we are right now. We've been talking about whether a bottom's in, whether there's any kind of stability that we're starting to see. Do you see it or not?
So I've been pushing back, Andrew, against this notion that we had established the bottom. Do you remember I called it a counter-trend rally? Yep. That we were still on a downward trend. And I think we are. And the fact is, Andrew, most people haven't priced in the uncertainty surrounding, first, the duration and severity of the shock. Second, how long it will take to get the money that's being pushed out by policies into the hands of businesses. Third, how tricky the restart is. And finally, the post-crisis landscape. So until we price that in, unfortunately, it's still more of a downside for markets from here.
And in terms of pricing that in, though, in terms of just walk us through the permutations with which you think it will get priced in and when? Meaning,
so it's going to be
sequentially. I think investors are still either looking for or they clearly, in your mind, must be missing at this point.
No, look, we haven't seen this sort of shock before. We've never seen a sudden stop to the global economy. So cognitively, it's taking us time to appreciate. So, for example, a lot of people went into automatic rebalancing, not realizing that it is different this time around. And that's the favorable technical that we've had, and that's running out right now. So it's a cognitive issue. It's going to take time. We're getting there. Very few people are talking about V's now. There's a recognition it's more of a U. And we're just going to get there sequentially. We're going to understand that there is massive uncertainty about the duration and severity of the shock. And there is delay in getting money into the hands of people, which means, unfortunately, and I stress, this is really unfortunate, liquidity problems are going to become solvency issues for some businesses. And that's a real concern.
So for those investors out there who are watching us this morning, who have cash on the sidelines, who are waiting, thinking that there's a bottom or they're trying to pick the bottom, which is almost an impossible task to begin with, what are you telling them they should be doing?
So I say you're not going to be able to pick the bottom. Whatever cash you have, divided over 5 installments. So the notion of averaging into the market, and make sure if you really want to go in at this point, I wouldn't, but if you really want to go in at this point, do a fifth now, a fifth next month. I know it's not very sophisticated, but no one can tell you for sure how these dynamics are going to evolve. We simply have not seen this before.
Hey, Mohamed, can we go back to that point you were just making, the idea that this is going to become a liquidity issue for a lot of companies that are out there? I don't think we've spent enough time on this, and I think that's kind of like the ugly undercurrent that's rolling through all of this. We may have seen this initial drop-off and this initial sell. If we can get back to normal quickly, maybe some of these businesses are okay. But I think there are a lot of companies that have taken on debt, a lot of things that have happened. And with this sudden stoppage, it changes the picture for everything.
You're absolutely right, Becky. So there's 2 groups of company, broadly speaking. There are those that have access to debt, and they are taking on a ton of debt. We've had record investment-grade issuance. We've even had some high-yield issuance. And they are building a ton of cash buffers, which they should. But when they come out, their earning power is going to be less. So their credit worthiness is going to be weaker. And on the other side, you have companies who unfortunately do not have access to loans or to debt issuance. And for them, a liquidity problem will become a solvency issue, which means a reversible shock will become a permanent capital impairment shock. So wherever you look, we're going to have to price in a different post-crisis landscape. And that's one of the 4 things that as yet markets haven't got their arms around. They will, but unfortunately it means lower valuations from here.
Hey, Mohamed, can you just walk us through your own timeline that you're using in your head to think about this crisis? Because, we've asked basically all of our guests what their timeline is. And I would say right now a consensus timeline that you keep hearing is sort of a mid-May or even early June, that there's some return. I don't even know what that return looks like. Some people think that may be the consensus right now. I know some people think that's aggressive. I know other people who think that's not optimistic.
So I get a sense that the timeline is even shorter in most people's mind, and that's what's priced in. And there's this notion that we can be date specific. At this point, we're going to turn the switch back on. And unfortunately, that's not how it works. First, we don't know where that date is. And secondly, it's not just a matter of turning the switch on. This is a very complicated restart that people haven't really thought about yet. I don't have a time, and I would encourage investors not to have a time. What I would encourage investors to do is first have the resilience for the journey. Make sure you can stick through this journey, which is going to be volatile. Second, have a few things that you're looking at to tell you when it is you're getting closer to the definition of a timeline. And third, have the agility to move when you see it. Don't get hooked on a particular timeline. Rather get hooked on these three processes. And that's how you're going to navigate a really difficult journey, but the destination will be better for markets.
Given your concern about credit and liquidity turning into a solvency issue, for those investors who may own certain sectors or certain stocks, is there a certain screen that you would put on the market right now for those investors who are saying I should get out of certain things still at this point, based on what you're saying?
So the trade is, and you've heard me say this for the last 2 weeks, up in quality, and you're still having an opportunity to go up in quality. So what does that mean? If you own a company that has any of these characteristics, you should go up in quality. One, if it has no cash reserves or insignificant cash reserves. Two, if it's very negative cash flow. And third, if it has a lot of debt falling due. If you own a company right now, you are betting not just on a bailout, you are betting on a bailout that's not going to undermine the capital structure. And I think that most of these bailouts are going to come with conditions. So be very careful if you're trafficking in low quality companies, whether you're doing this in high yield bonds, triple Cs, double Cs, or whether you're doing it in certain stocks.